Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world without putting you to sleep like a boring accounting lecture. Today we're diving into Orchid Island Capital's latest quarterly report, and let's just say they've been busy navigating the wild world of mortgage investments. Think of it like trying to surf with a bunch of rubber ducks in a hurricane, and you are starting to get the picture. Orchid Island Capital Incorporated is a real estate investment trust, or REIT, that invests in mortgage-backed securities. Essentially, they buy up bundles of mortgages and try to make money from the interest paid on those loans. It is a complicated business, especially when you are dealing with fluctuating interest rates and the constant possibility of people paying off their mortgages early. Their reported net income for the 9 months ending the 30th of September 2025 was a hefty $55.6 million. That sounds great, but then you look at the same period in 2024 and it was only $32.1 million. So profits definitely improved on a quarterly basis. The third quarter of 2025 brought in an even bigger $72.1 million compared to just $17.3 million in the same quarter of 2024. Those are some pretty big jumps. So what is really going on here? Let's peek behind the curtain a bit. Their interest income, which is basically the money they earn from the mortgages they own, shot up significantly. For the 9 months ending the 30th of September 2025, it climbed to $281.8 million from $169.6 million in the previous year. That is over $112 million more. This jump is attributed to two main things: higher average mortgage, backed securities on their books, and a slight increase in the yield they were getting on those securities. But here is the catch. Making money on mortgages isn't free. They have to borrow money to buy these securities, and that borrowing cost, their interest expense, also went up. For the 9 months in 2025, it was $212 million, an increase from $172.4 million in 2024. Now, even though borrowing costs went up, their income rose even more. This is why their net interest income, the difference between what they earn and what they pay in interest, went from a negative $2.8 million in the 9 months of 2024 to a positive $69.8 million in 2025. That is a massive swing. They also talk a lot about economic interest expense and economic net interest income. This is their way of trying to show the real economic cost of their borrowing and lending activities, even after accounting for all the complex financial instruments they use to manage risk, like futures and swaps, for the 9 months of 2025. This economic net interest income was $133.5 million. It is a way to strip out some of the accounting rules to see the underlying business performance. How are they borrowing all this money? Their main tool is repurchase agreements, which are basically short-term loans secured by their mortgage-backed securities. As of the 30th of September 2025, they had about $8 billion in these repurchase agreements outstanding. This is a huge number and shows how much leverage they are using to magnify their potential profits. Speaking of leverage, their adjusted leverage ratio was 7.4 to 1. That means for every dollar of equity they have, they're effectively borrowing $7.4. It is a high ratio, which means they're heavily reliant on borrowed money to operate. This can be great when things are going well and interest rates are low, but it is also a double-edged sword if things go south. Now let's talk about the value of their investments. They've got a lot of unpaid gains or unrealized gains on their mortgage-backed securities. For the 9 months ending the 30th of September 2025, this figure was a whopping $146.5 million. This means that if they were to sell these securities today, they'd make that much profit. It is free money on paper, but all that hedging they do to manage interest rate risk can swing wildly. For the 9 months ending the 30th of September 2025, they had losses of $136.7 million on these. That is a significant amount. While hedging is crucial, it is clear these instruments can also lead to big paper losses. Looking at their expenses beyond just interest, they spent about $14.7 million in 9 months for things like management fees, overhead, and professional services. This is up from $12.4 million in the prior year, showing that running this operation isn't cheap. The management fees alone, paid to their external manager Bimini Advisors, Incorporated, are calculated based on their equity, and as their equity grew, so did these fees. In an effort to beef up their capital and fuel growth, Orchid Island Capital has been active in issuing more shares. Through the 30th of September 2025, they issued over 56 million shares under their February 2025 equity distribution agreement, bringing in about $420 million in gross proceeds. This is a key strategy for them to raise capital without taking on more debt. They're heavily invested in futures contracts like the 5-year T, note futures where they hold short positions. This means they're betting that the price of these futures will go down. As of the 30th of September 2025, the contract value of these short positions was $614.3 million. This is a massive bet on interest rates moving in a certain direction. Now, what about the shareholders? We're all interested in dividends, right? Orchid Island Capital has been paying them out. For 2025, they've declared dividends totaling $1.20 per S-Hair year to date, reaching $147.2 million in total. They've consistently paid out a significant portion of their earnings. This company seems to be on a constant treadmill of issuing and then renegotiating these equity distribution agreements. It shows they are actively managing their capital structure, but also highlights the ongoing need to raise funds through share sales. Past now, putting it all together, Orchid Island Capital is playing a high-stakes game in the mortgage. Backed securities market, they're leveraging heavily, meaning they're using a lot of borrowed money. This magnifies both their potential profits and their potential losses. Their success hinges on managing interest rate risk carefully and ensuring that the income they generate from their mortgage investments stays higher than their borrowing costs. The big jump in profits for 2025 seems to be driven by rising interest income which outpaced increased borrowing costs. But that big swing in gains and losses on their hedging instruments shows just how volatile this business can be. They're making smart moves by issuing shares to boost equity, but that high leverage is a constant nail-biter. One of the biggest risks they face is that their hedges, while designed to protect them, might not always perform as expected, especially in rapidly changing markets. And the ongoing regulatory landscape, with potential changes to how they operate and how the enterprises they invest in are structured, adds another layer of uncertainty. Overall, Orchid Island Capital is navigating a complex environment. They're generating solid returns when interest rates are favorable, but their heavy reliance on leverage and volatile hedges means they're always walking a tightrope. They need to keep balancing their investment strategy with robust risk management to keep those dividends flowing and their business growing. What do you all think of Orchid Island Capital's approach to the market? Are they playing it smart or is the leverage just too much? Let me know your thoughts down in the comments. If you found this breakdown helpful, do us a favor and hit that like button. And for more deep dives into company financials, make sure you subscribe and ring that notification bell. We also have a Discord community linked in the description below if you want to chat more about these reports. Thanks for watching, and we'll see you in the next one. Tween Pass.